Welcome to the Lolly Investor Programme. Last time when I talked about the principles of investing, I said it was a good idea to spread your money around the different types of investment. This time we're going to start looking in more detail at the three main asset classes as they are known. They are shares, bonds and property. There are big differences between them, but I'm going to look at the thing that links them, which is income. With interest rates stuck at an all-time low of 0.5%, way below the rate of inflation, almost everyone is looking for income from their investments. Income is like cash in the hand for investors, and in these troubled times, that's what they like. Which investments they choose and how much they're prepared to pay depends on what kind of income they want and what kind of risk they're willing to take. Let's start with property, for that's the asset class most people are familiar with. The funny thing about property is that although we don't think about it in this way, it is the investment category most closely tied to income, or rent in this case. For example, most of us buying a property to live in would not think about the price in terms of the rent it would fetch, which is funny given that most of us tend to start off as tenants before clambering onto the property ladder. That's not how professional investors behave, nor for that matter private investors involved in buy-to-let. Many of the flats in the development behind me will have been bought by buy-to-let investors who, if they were doing their job properly, will have thought a great deal about the rental value of the properties. In the commercial and investment world, rental yield is a key measure of the financial return from commercial property, whether it's an office block, a warehouse or a shopping centre. You don't need to be a rocket scientist to see that the return, or yield, from a property investment is the rental income minus the costs of maintaining the property and paying the mortgage, divided by the price paid for the property. In other words, if as an investor I know what return I want and I have a good idea of what rent I can charge and I know what my interest payments are, I can calculate the price I should pay for the property. Put simply, if my yield is 6% and my costs are 4%, then the property's worth buying. But if my yield is 3% because rents are falling and my costs are still 4%, then I'm going to lose money unless the price of the property goes up. However, that's unlikely to happen if the rents are falling. That's the trap some buy-to-let investors fell into a few years ago. They assumed property prices would continue to go up and didn't anticipate that their rental yields would fall below their costs. So you see, property is a good example of an asset class where price is fundamentally linked to the income it is expected to produce. Next time, I'll look at how the income story applies to shares.